It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome back. Johnny Dean here with certified financial planner professional, Professor Rick Plum. You're the advisor of the group. You got a lot of knowledge here. Anyway, welcome back to the podcast. One quick thing. Last week we talked about, in last broadcast, we talked about things that people didn't, 3 tax law benefits that people didn't know about.
May not have known about.
And I meant to bring up one just as a sidebar because I completely forgot. But about a week ago, I was speaking with somebody who was just kind of in a panic because they thought they had to have their taxes done by April 15th. And they were working 2 days before. I can't be bothered. And I said, well, this year it's been extended.
2021, they extended it to the 17th of May.
17th of May, which I guess would be a Monday. Yes. Because the 15th
was a Saturday.
Yeah, so you have an extra. And first she didn't believe me. And then she said, "Are you serious?" I said,
"Well, practical
yeah.
Joker John."
So I know. Well, but
taxes,
she says,
I don't joke about.
Well, I'm going to do them anyway. I don't know whether she really
fine,
did.
Do them. I mean, that's fine.
But if you aren't paying attention, that's one of those things that could be.
That date can creep up on you.
It can be, but that thing could be under the radar where you thought you had to get them done. Now, last year I think we had till July 15th or July. Something.
It was extended a lot further than April.
Right, of course.
May.
And I'm glad they did this again for 2021 for last year's taxes.
And the spin is that they're helping you out. No, they were backlogged, and there were some changes made at the beginning of this year that affected last year.
They meaning IRS?
The Congress to the IRS is just a collection agency.
Yeah.
The Congress made some changes that affected last year, and so they had to make they had to redo all their computers, redo all their paperwork, redo everything.
That's true, yeah.
And they just weren't, the stimulus checks and all this other stuff, that especially the ones that happened towards the end of last year.
Yeah.
They had to find a way to get them accounted for appropriately on the returns. So the IRS needed the time to be able to process returns appropriately.
Perfectly fine. You want to wait? They
even did another thing, later on that, where they exempted the first $10,200 of unemployment insurance from taxation. And
federal or state?
Federal.
And federal. Just federal.
I think most states have complied with it. I'm not sure of every state. But that was done after the filing dates had even started. So some people that filed early, They didn't know about it, and so their tax was calculated on maybe $10,200 more income than they should have been taxed on. So the IRS is going through, and they had to redevelop it, and they're just sending refunds to those people equal to the tax on that $10,200.
So they're making the calculations and
right. They're saying don't bother filing an amended return on that.
Good.
We'll catch you.
Wow. Oh, that's good. So let's get back to this. Speaking of things that you don't know, that you weren't aware of, the unemployment, the first 10,200 because some people got state and federal.
But unemployment, basically normally unemployment is a taxable issue, not subject to FICA or
No, but for whatever reason.
But it is a taxable ordinary income item,
Yeah.
so it goes on your tax return in the taxable column. If you made $10,200 or less, you don't have to show that in the taxable column. Now,
some people, I think, had it withheld, so that could.
Well, they just get it back as a refund then.
Yeah. Oh, that's cool. Okay, that's good. Why tax unemployment? Not to get off on this, we have other stuff.
It's a wage supplement.
Why don't you just send me the reduced amount? Pretend like you paid me $10,000, and just send me $8,000.
Because they can make you feel better by giving you the higher number, and they feel better about giving you the higher number, even though they take it back later, and you don't realize they're taking it back later.
Well, the reasoning went because, if we don't tax them, they're just going to sit around and be lazy bums. Well, I don't think that's the incentive. I think it just makes things even worse, especially during a period of time like last year where some people both lost their jobs, and now they barely survived on unemployment, but I owe taxes, so one of the good things is that $10,200. At least that helps a little, I would hope. I didn't mean to get into that, but that's interesting. I guess I didn't know that. Now, one last thing. Stimulus checks for this last round, which just happened earlier this year, February, March, whatever, the 2021 checks. Is that also the same as the prior year where it's
a
an
refundable
advance
tax credit.
It's an advance on your
tax credit.
Yeah. So if you don't
right, so that will be accounted for on your 2021 tax return that you file early 2022.
Yeah. So if for some reason you didn't qualify for this round, let's say.
For some reason, because your 2020 income was too high.
Well, yeah, yeah. So if that's the case,
but your
2021 income was
then you'll
cut,
get it. Then you'll get it as a refund.
Cool. So you can go back and it'll be accounted for on your tax return that you fill out next April.
And the other side of that is people who had a lower income in 2020 because of all the things that went on, but then got back to work and they're making beaucoup bucks this year. That doesn't show up on the books yet because they're making it this year.
They
get their stimulus check in April, February, March, whatever it was, and they don't have to pay it back.
I love it, and that happened last year too. That was part of 2020s as well. That's great.
If you got it and you weren't entitled to it,
keep it.
Tough. You get to keep it.
Absolutely, it's stimulus. My goodness.
If you didn't get it but you were entitled to it, you get it back on the tax return for that year.
Yeah. That's great. That's great. Good stuff. Good stuff all across the board. Now, I'm trying to transition from that because that just, I spent 5 minutes talking about that. But I'm trying to transition from that into what I wanted to get into. Now, okay, the question that we're trying to answer questions here that people have, common questions that people have about financial planning, about hiring an advisor. And one of the things that we came up with, because you mentioned it, Professor Plum, was people tend to ask about the fees. Now, they should ask because you need to know what you're
am I paying for this.
If I'm hiring you as a financial advisor, what is it going to cost me? It can't be free. Well, you've got to get paid for your work.
You're not totally attached to that right arm or left leg, are you? I mean, charge you an arm and a leg for this.
Okay, there you go. But no. Well, and that's what people don't know. They think, well, what, are you just going to start taking money out of my portfolio? How does this work? So, Professor, let's just start at the basics here.
It works in a lot of different ways, and it depends. Now, the industry itself is being pushed by the regulators and others to go to a fee setup. Commissions are inherently bad. The regulators hate them. They want to try to get rid of them. And so they've gone from where we used to be in this industry, which was primarily commission-based, whether it be mutual funds or stocks and things of that nature, to more fee-oriented, fee-for-service. You pay us a retainer, we're on retainer to do certain things. Now, there's different ways to pay. It depends on what you're asking for as well. But the most traditional way right now are for assets under management. You pay a percentage for somebody to manage your assets. And so it depends on how they're being managed also. But typically, they're going to charge you a certain percentage. Now, that fee is a stated fee, so the fee will be static, but the dollar amount obviously will change based on the value of the portfolio. And so when you hear somebody say, we get paid more when you do well, that's because they're charging a stated fee, and if your portfolio does well, they still get that same percentage, but on a larger pie, so they get a bigger piece, the bigger dollar.
Yeah, so if it's, I'm going to throw out a number, 1% because it's easy. 1%
you get $1 million, you get $10,000, you're paying $10,000 a year for all your advice. If it's $2 million, you're paying $20,000. Well, I get more if you do better. Now, obviously, if we can turn $1 million into $2 million, that's fine, but it isn't that clean. But that's the whole idea.
So is that the common way to do it now?
That is becoming the more common way.
So whatever I have invested with you, and I'm saying just
the advisor,
whatever I have. So if I hand the advisor, let's say $1 million, and say I want you to bucketize it or whatever it is you want to do. I want an income, and you guys handle it for me.
Well, that's a different issue because there's different, like I said, the basic way is just to charge a flat fee. Now, some people can take that idea of charging a fee a little overboard. I saw a couple years ago now, but the gentleman that was advising, it wasn't anybody with us, it was out of Arizona, they charged a percentage on the net worth, including the equity in the home, including the equity in areas that they didn't have anything to do with.
Wow.
And so I wasn't real fond of that one. No. But I also know people who will charge a fee based on the investment portfolio, whether they manage it or not. There's a tiered structure. So if you want me to do, take your 401k and help you allocate it, then I'm making recommendations, and when I make recommendations, I'm liable for my recommendations, so there would be a fee. But because I'm not actually managing the internals of that, I'm only managing the top of it with the mutual funds, that fee may be less than if I were managing it day to day or had my internal team managing it day to day. So it's all a matter of tiers and what's actually going on. Sometimes financial planners will charge a planning fee, a flat planning fee, a retainer, and say, for all your financial advice, we're going to charge you this. And then the asset management fee is a separate area where, there's a flat fee for planning. And then if you want asset management, well, you pay for your asset management. If you want to buy an annuity or insurance, there's usually a commission involved over there. The big issue is you need to know what you're paying. So if a recommendation is being made, you can and you should be asking, what am I paying for this? And it's not necessarily, what am I paying you, Mr. Advisor?
What
am I paying in total for all the parties involved? And first off, who are all the parties involved? So if you have assets under management, you're involving the financial planner. The financial planner would say, I'm going to charge you 1% of the assets under management. That sounds okay, whatever. And so they charge 1%. Then they didn't tell you that there's also 0.25% for the platform fee.
In addition to that one.
Oh, in addition.
Wow.
And then I'm not the one actually, or that advisor's not the one actually picking and choosing and doing the analysis and doing the stocks. Somebody else is doing that. There's, half a point, 0.6, 0.4, whatever the number is to that person. Or they're using mutual funds. So you need to know the internal expense ratios of the mutual funds. And so there are layers of fees. You just have to understand what they are. And so what is it that you're actually paying? And so when somebody says, oh yeah, I charge you 1%. Okay, I understand you charge me 1%. What are the other fees involved? I mean, basically, there's some also little miscellaneous fees, depending upon the size of account. They're nuisance fees, or they may be larger, but $20, $30, whatever the number, for an IRA. So each IRA you have has an IRA fee charged by the IRA custodian. It's a flat dollar amount, anywhere from $10 to $100 per account. And so having multiple accounts, splitting it up into different accounts can start getting, eating into your fees.
This seems so...
But you just have to understand what's going on and try to make your life simple. But just know what the fees are. Yes, right now the fee for service game is the way the regulators want it to be, because they put everybody on the same side of the ball.
So when somebody hands over money to a financial advisor, they're supposed to, I would hope, tell you up front.
Oh yeah, the advisor should be telling you.
Not just the advisor's fee, but all these other ones that may be included, right?
I don't know that they're doing that. I think they should be doing that. I know we do that. But yeah.
So how do you do it? That's what you do?
Okay. Somebody comes to us with $1 million. Not all of it may be in the fee for service area. Some of it may be sitting in cash to be spent for the next year. Well, you don't pay anybody for cash.
So there's no fee. There would be no fee on that because it's sitting in a money market or CD or whatever.
Yeah. And so, or they may buy a fixed annuity, for 3 years. That because it pays better than a 3-year CD. So that doesn't have necessarily a fee because nobody's managing it. We're not the fixed annuity company was managing it and giving that fee out guaranteed by the insurance company. So maybe those are not part of the fee for service. There's other certain products. Right now, we're in a transition going from what was primarily a brokerage industry to they're pushing for primarily a fee industry.
Commission to fee.
Yeah. But there are no perfect one size fits all everywhere yet. So all fee, there may be areas that you want to have some product in there that doesn't have a fee associated with it. So you've got this transition point where there could be some brokerage in there that makes sense. Now, you need to know that it makes sense.
You're talking about a brokerage fee.
No, I'm talking about like a brokerage product that...
Oh, the product, why it's been
which is being offered on a commission basis rather than an every year fee basis.
Yeah.
Now, the more we get pushed, the more the industry is pushed towards the fees, the more the companies that used to be primarily brokerage are creating products that are actually acceptable, that have an ongoing fee associated with it. But I mean, when they first started, the products that were primarily brokerage, all they did was say, okay, now you can charge a fee on them, but they didn't get rid of the back-end charges. They didn't get rid of the surrender charges or the surrender period. They didn't get rid of the negative side of things. They just said, we're going to charge a fee on it, but it didn't help us at all. It didn't. I mean, when I say us, I mean the client. It didn't benefit the individual at all. It actually hurt the individual.
How are these fees paid? I mean, if you charge a 1%...
Typically, they're charged on a quarterly basis.
So does that mean that the client writes a check from somewhere? Can it come out of the funds that are invested? I know there have been some rules changes.
Generally, they come directly from the funds invested. And again, it depends on what fee you're paying. Financial planning fee, where you may not have any funds that are being invested, that's going to be debited on your card. It's going to be paid by check. Generally, they avoid billing and waiting for a check. They find a way to take it and then deal with it. So if there's no assets under management, it'll be some form of a subscription billing fee, whether it be done by check or done by automatic debit. That's one issue. If it's assets under management, where there's a $100,000, $500,000 portfolio, they usually take it right out of the portfolio on a quarterly basis.
So if I have...
If it's a 1% fee, total fee, they're going to take 1/4 of 1% every quarter. They just cut it into quarters.
Okay.
And they take the value at the end of the quarter, and maybe the fee billing is 2-3 weeks into the quarter. So it comes out on the next statement.
So if I'm going to use $1 million because it's easy.
Yeah.
But if I said, okay, here, Professor Plum, here's $1 million. Now I want $40,000 a year out of this. I want you to bucketize this in whatever way you do. Tell me how you do it and all this stuff, and just I'll let you do this.
Well, we'd have to go through and look at how we're actually doing it. But if it were 100% in assets under management,
what does that mean?
Meaning charging a flat fee, a percentage fee, flat percentage on all the assets, regardless of where they're invested. I mean,
even if it's a money market for bucket one.
That's why.
I understand. I don't want to.
You're making it impossible to answer in a radio format.
I understand.
But,
okay,
you've got your year's worth of cash outside of it, and you got another $1 million invested.
Yeah. All right. Do that. Do that. Yes.
And they're invested where there are managers. There's people picking and choosing individual
funds.
Securities. We try to stay away from funds with $1 million account.
Okay.
We think that even the S&P 500, all 500 of those stocks are not good options. So let's get rid of some of those 500 and get down to more condensed portfolios, and also get away from any of that management fee and just use our own management fee. But let's say it's a 1%. They're going to charge a quarterly fee, and they're going to look at the value on the end of the month, whatever the end of the quarter for them is. Sometimes it's based on the end of the 3rd, 6th, 9th, and 12th month. Sometimes it's the 4th, 7th.
Okay,
whatever.
but it's done on a basis.
It's done on a quarter, and they just take the money. In almost every managed account, there's going to be a little bit of cash anyway, just for moving back and forth, or some dividends being earned and things before it can get reinvested, and they'll just take it out of the cash account.
So as a consumer, as a client who really knows nothing about fees, what should that person be asking?
What am I paying? What am I paying for? What am I getting? And how much am I paying? What is the fee? Not just the fee you're charging me, but the total fee that I am paying. And when is it going to come out? How is it calculated?
And anybody who isn't clear about that you should not do business with that person, I would suggest.
Well, not until they can get you a clear answer.
It's you used to go from the commission products where it was all that, and people.
The problem with the commission products is people
recommendations.
No, not just that, but people never told them what the commissions were, and commissions could be very high in some areas.
Oh, sure. Yeah.
So you've got two products on the table. One, pays 3% guaranteed to the client for 5 years, and the other one pays 2.75% guaranteed for 5 years. Well, the first one has a commission of 2%. The second one has a commission of 5%. Well, the more unscrupulous person's going to go for, they're not going to miss a quarter point, but I'm sure going to enjoy that extra 3. So that was the problem, with the commission-based world. It's hard to really know whether you're getting a good deal. What
do you see as the problems with the fee base? One that I personally could just see is if I had a portfolio of bonds, you're going to charge me X percent. That's going to eat quite a bit into my, especially in a low interest rate environment, is going to eat quite a bit into my rate of return, right?
It can, but can you do better without it? That's also part of the issue. The portfolios that we see in the bond portfolio area have been earning, even after the net of the fee, a reasonable rate of return that most people aren't getting on their own. And so it's, the fee itself is people say never pay a fee. Well, if I can pay a fee and get a better return than I would have on my own, have access to areas, have a better risk return relationship than I would buy on my own because I don't understand what the heck's going on out there. So I mean, I know that I've seen some managers in the bond area. You want to pick on bonds. Bonds are tough. Because for the last how many years have we been talking about interest rates have got to go up?
Sure.
I mean,
10 years we've been saying.
In 2017, they hit a low, and we thought, well, they've got to go up from here. So you don't want to go out long on your bonds. You don't want to. You want to shorten your durations. And then they went up for a little bit, and then dropped to an even lower level, to where we saw historic lows last year. And so, if you've got somebody who can analyze and look at the risk-return relationship and understand the economics of what's going on, adding a little bit of a long-term portfolio to a strategic bond portfolio, which has short-term, mid-term, long-term, high-yield, corporate investment, all the different things, it can add overall return without adding the risk. And so where are we on the risk-return pendulum as far as what is that bond adding to or taking away from the portfolio? And for a while, the managers I've seen have been able to get some extra juice, out of the portfolio by adding in some of what these would normally be considered more aggressive, more risky, and then pull away from them as the economic conditions deteriorate, and now it becomes the risk pendulum the pendulum is moved over to the risk side rather than the return side.
How does this relate to fees, though? Some are going to say, but how does that?
Are you doing that on your own?
Yeah, so I'm paying a fee to
get that kind of advice,
and get somebody to
get a greater return in those areas, and get a more risk-adjusted return in those areas, and that also helps pay for the financial planning advice on everything else that you get.
So when you're paying a fee, you're essentially getting this type of...
You should be getting value for it, whether it be reduction of risk.
What do you see as value? Yes, go through some of those things.
Reduction of risk, understanding, areas of expertise that you do not have, access to areas that you didn't even know existed, just a more thorough understanding of what's happening, a sounding board to say, you don't want to sell right now in April of 2020. You don't need this money to spend. You don't need to be selling out right now. So
you're paying for psychological advice?
Yes. When I first started this industry 150 million years ago, I was thinking a finance degree, an economics degree, business degrees. Those are the degrees to have. And yes, I still think they're very important. But a psychology degree sure helped. I don't have one, but...
Well, when it comes to money, when it comes to your own personal finances, absolutely, I would think it would be.
But all of your Social Security strategy, understanding taxes, but also understanding that taxes are not the be-all, end-all of everything. I saw a portfolio recently that held a certain stock that was purchased almost 12 months prior to this particular instance. And at the time, that it was purchased for like $15-16 a share. It was an individual security portfolio. And I think it quintupled over the year. And the managers, through their analysis, said, we need to sell this. Now, as an advisor and as an individual, we say, it's 360 days. I don't want to sell this for 5 more days, 6 more days, actually.
Because of the tax treatment.
Because if you sell it now, I've got a great home run going, but I'll have to give back a couple of those bases for taxes.
Well, because it's what we call short-term capital gains taxes.
Which is taxed at the same rate as ordinary income.
But if you can get it past the 1-year mark...
Then we get long-term capital gain rates, which are better.
Significantly better in some cases.
And the managers were saying, no, there's something on the horizon, I won't get into what it was, that does not look good. So you're taking quite a bit of risk. Now remember, it's a short-term issue, and unfortunately for people that held on, that particular stock dropped. Well, it was over $100 a share, and now it's been about a month, it's at $40 a share. But within the first 3 days, it dropped, maybe it wasn't 5 days, it was maybe a week to 10 days out from the event, but from the 365 days, but it dropped 20-30%.
And so
you need somebody to be a sounding board, not only for the emotional aspects of it, but who understands the taxation and the risk associated with it. I remember back years ago, I think it was 2011, we had a very good year, or maybe it was 11, 13 maybe, I can't remember what year it was. They had a portfolio, they said, I just want to hold out for another month. And we're saying there's a lot of, things have changed. You've got a significantly better, you're up 30-40%, you expected 10. I know you don't want to pay the tax, but this is getting kind of dicey here. Let's take some profits off the table. Well, when the year mark, they didn't want to do it. When the year mark came around, they didn't have to worry about paying the tax at all because the portfolio had dropped 30% and they didn't have any gains anymore. So taxes are an issue. Taxes are another drag. It's like a fee on the portfolio. It's a drag on the portfolio. But it also has to be taken into consideration with risk. How much risk am I facing with this issue right now?
So somebody who's paying a fee to an advisor is paying them to look out for things like that.
Well, they're paying them to look out for how much time do I have to get to the year mark, and what's the risk of waiting the next 2 months, the next 2 days, whatever the time period is to get to the 2-year mark or the 1-year mark.
And that's the kind of stuff that you do all the time.
That's the kind of things that we look at, and it becomes an issue because nobody wants to sell and create taxes. I mean, I know people that have held onto a stock for 30 years, and they will not sell it because they don't want to pay the taxes. And at some point, you realize that, well, there's only 2 ways to avoid paying taxes.
One of them isn't very good.
One of them is to lose the gain. The other way is worse. You have to die.
That's bad.
That's worse.
That's right.
Although that issue may be rectified in the not too distant future if they take away our step up in basis.
Yeah, don't get me started on that. I don't know how serious they are about that. That would not be a good thing.
I don't think it made it into the bill. I think
I would hope not. I hope common sense prevails.
I'm sorry.
Once in a while it does. Once in a while, if enough people squawk about it, it does. I realize a lot of this for folks listening might seem a tad bit technical, and I hope it didn't. But I think what people need to take away from all this, Professor Plum, is that there are potentially, it sounds to me like there are potentially quite fees can add up.
They can.
Under certain circumstances.
You just need to know what they are and what you're getting for them.
So you need to know what they are and what you're getting for them. Then you need to, as the client, need to make the decision, is this worth me paying for it?
Could I do this on my own?
Right, exactly. I mean, is it worth me paying for something? Well, it depends on what I get back. That's every transaction in the world.
Do I understand the tax system well enough to do this? Do I understand the risk management system well enough to do this? Do I understand the markets well enough to do this? Do I understand Social Security well enough to do this? Do I understand my pension? Do I understand all these different areas? And if you do, A, God bless you. B, bring your application down.
Because we'd like to talk to you about that. Now, I should mention, too, a couple of these scenarios you mentioned where it worked positively. There's no guarantee that, that everything is going to work positively. I mean, we don't know. But the advice that you're paying for, the advice and the expertise, quote unquote, behind it, and it really is expertise, I think I could say, that's what you're paying for. And if that's worth it to you, then a fee should be worth it to you.
Well, if you want somebody to work on your behalf and do something on your benefit, you pay for that.
I pay my doctor for their expertise in medicine, so I don't necessarily mind writing a check here and there if it's worth what I'm getting back.
Right, and we kind of have them on retainer by paying a premium to our insurance company every year.
Oh, man, we sure do. We sure do. Folks, if you have any questions about things like this, honestly, you need to talk to your advisor. Doesn't matter who they are, but you need to talk to them about the fees that they're charging, fees that they could potentially charge, and how much is actually not just to the advisor, but how much is actually going out of your pocket or out of your portfolio every quarter, every 6 months, every year. Whatever it is. It's important that you understand that stuff. And if you don't understand it, make sure your advisor gives you that understanding. And if you're still not satisfied, maybe it's time to find somebody who can answer it for you.
Right. Now, I have run into people who don't want to understand. It's like, here, just do it. I don't care. Well, you still need to know about what you're paying.
Yeah, and it should be in writing somewhere. So even if that person says, I don't really care, have it in writing because somebody else may care.
Yep.
And it should all be spelled out. We call it full disclosure, I guess.
We call it full disclosure, and that has to do with whether or not it's a brokerage item, a fee item, or whatever item. You know what's happening.
Yes.
And you know if you know what you're paying for something, then you can evaluate whether or not the advice is real for you.
Yeah, and you can evaluate it on an ongoing basis.
If you have no idea what you're paying, how do you know if what I'm recommending is actually in your best interest or mine?
I appreciate this, Professor Plum. I appreciate you folks listening. Again, if you want to get in contact with Professor Plum or any of the team of advisors at Lucia Capital Group who do different things like that. We have a planning side. We have an investing side. They also look into things like estates and tax law. Now, we don't do estate work
No, we help people educate what the basics of estate planning and things like that, but we cannot do the actual estate planning work. We can help you, set up your beneficiaries and things of that nature, but we cannot do legal work in any way, shape, or form. We're not attorneys.
No, but you have access to certain people who do that, tax attorneys and things like that as well.
We can refer out to that.
Absolutely, yeah. So if you need any help with that stuff, please give them a call, 800-644-1150, 800-644-1150. Talk to the advisors. You can talk about fees. I think it's important that you talk about fees and decide for yourself. You can also go to luciacap.com, which may be where some of you are listening to this podcast or found this podcast. Don't forget to subscribe as well. We got interesting topics all the time. We got more coming up, and we do this every single week. Professor Plum, thank you so much.
You're welcome.
We'll probably catch you. You'll probably be my guest next week. You never know. For Professor Rick Plum, Certified Financial Planner, I'm Johnny Dean, host, podcast moderator, and we appreciate you listening. We'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. A mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Mutual funds are divided into several kinds of categories, representing the kinds of securities they invest in, their investment objectives, and the type of returns they seek. Mutual funds charge annual fees, called expense ratios, and in some cases, commissions, which can affect their overall returns. Investing in a share of a mutual fund is different from investing in shares of stock. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other important information, call your financial advisor. Read the prospectus carefully before investing. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License number 0518721. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.